4 months ago, I sat right here and told you something that most people in the investing world didn't want to hear. I said VOO, the single most popular ETF on the planet, might not be the best path to financial freedom. I said there was a smarter way, a 2 ETF setup that gives you growth and income at the same time. A lot of people pushed back. Comments said I was crazy. Just buy VOO and forget it, they said. You can't beat the S&P 500. Well, let me tell you about Sandra from Tampa. Sandra watched that video the week it came out. She'd been a VOO-only investor for 6 years. She didn't sell everything overnight. She just started splitting her new contributions, 70% into VUG, 30% into VYM. Then the first quarter of 2026 happened. The S&P 500 dropped about 4% in 3 months. It was the worst quarter since early 2022. AI stocks got hammered. The Iran conflict pushed oil above $100 a barrel. The Fed didn't cut rates. Headlines were ugly. But here's what Sandra saw when she logged into her account. Her VYM position, up 10% year to date. Her overall portfolio, holding steady. She wasn't panicking. She wasn't refreshing her phone every 10 minutes. She was calm because she had a system that didn't rely on one bet. That's what this video is about. Not theory, not predictions. Real results from a real strategy in a real market that just tested it. By the end of this video, you'll know exactly what changed in the last 4 months, why the numbers now favor this approach even more, and how to set it up for yourself even if you're starting with $100 a month. And the part most people will miss, Vanguard just did something to one of these ETFs that confused thousands of investors. If you own VUG, you need to understand what happened before you make your next move. Quick note, I'm not a financial advisor or government employee. Everything here is for educational purposes only. For your specific situation, always check with a qualified professional. Now let's get into what actually happened to the market. What happened to the market since January? If the last 4 months felt bumpy, that's because they were. 3 big things happened at once, and each one changed the game for ETF investors. First, the AI bubbles started leaking air. Since late 2023, the market's biggest gains came from a tiny group of tech stocks: Nvidia, Apple, Microsoft, Amazon, Meta, Google, Tesla. People call them the Magnificent Seven, and for 2 straight years, they carried the entire S&P 500 on their backs. But in January 2026, investors started asking a dangerous question. Are these stocks actually worth what we're paying? The answer for many of them was maybe not right now. Growth stocks pulled back hard. Second, the Iran conflict. In late February, the situation between the US, Israel, and Iran escalated fast. Iran briefly closed the Strait of Hormuz. Oil prices shot past $100 a barrel. Energy stocks soared, but growth stocks, they took another hit. Third, the Fed did nothing. A lot of people expected interest rate cuts in 2026. They didn't come. Inflation came in at 3.3% in March, mostly from energy prices. The Fed held rates at 3.5 to 3.75%, and they're likely staying right there for the rest of the year. Now, here's why this matters to you. When growth stocks fall and rates stay high, dividend-paying companies do better. Banks make more money on higher rates. Energy companies are printing cash. Healthcare, consumer staples, industrials, all steady. These are exactly the kinds of companies inside VYM. So while VOO stumbled, VYM stepped up. That's not luck. That's the strategy working as designed. So now you know what happened, but there's a problem, and it's the one most people don't see coming. It's hiding inside VOO itself. Here's what I mean. Let me ask you a question. If you own VOO, how many companies do you think you're invested in? 500, right? That's the whole point of the S&P 500. Broad, diversified, safe? Here's the myth. VOO gives you 500 companies, so you're fully diversified. Here's the truth. 7 companies now control almost a third of your money. As of right now, VOO's top 10 holdings make up over 36% of the entire fund. The Magnificent Seven alone, roughly 30%. Think about what that means. If you put $100,000 into VOO today, about $30,000 of it goes into just 7 stocks. All of them are in tech or tech-adjacent sectors. That's not diversification. That's a concentrated tech bet wearing a diversified disguise. And we just watched what happens when tech gets punished. Q1 2026, VOO dropped 4%. The Magnificent Seven dropped even more. Meanwhile, dividend stocks barely flinched. Now, am I saying VOO is bad? No, it's still one of the greatest investment vehicles ever created. Low cost, simple, proven over a century. But the VOO of 2026 is not the VOO of 2015. The index changed, the concentration changed, the risk profile changed, and most investors haven't adjusted. This is the exact problem that 2 ETF strategy was built to solve. But since the original video, the numbers have shifted. And honestly, one part of my argument got stronger, while another part needs a correction. Let me show you both.
The updated numbers. VUG plus VYM versus VOO in 2026. All right, let's put real numbers on the table, because this is where it gets interesting. Over the last 10 years, VOO has delivered about 14% per year in total returns. That's excellent, no argument. But a 70-30 split between VUG and VYM, about 15.3% per year over the same period. That's roughly 1 percentage point higher on the exact same type of passive index-based investing. Over 3 years, the gap is even wider. VOO came in around 21.8% annualized. The 70-30 combo, about 24%. That's a meaningful difference when you're compounding. Now, year to date in 2026, VYM is up around 10%, VOO is up about 6%, VUG is up around 3%. If you blend those at 70-30, the combo is roughly in line with VOO, a hair under actually, because VUG's growth tilt got hurt in Q1. And here's the honest part I want you to hear, the part most creators won't tell you. A 70-30 VUG and VYM split actually produces less current dividend income than 100% VOO. Why? Because VUG only yields about 0.4%, VOO yields about 1.1%. Even though VYM yields 2.4%, the heavy growth tilt in the combo dilutes the income. So if your only goal is maximum dividends right now, this specific mix isn't the answer. A 50-50 split or a 60-40 split towards VYM would give you more income. But if your goal is total return, meaning growth plus income combined, with real diversification across investment styles, the 70-30 blend has the edge, and the longer your time horizon, the bigger that edge gets. That's the identity of a smart investor. You're not chasing one number, you're building a system that serves multiple goals at once. Diversification isn't owning more, it's owning different. Now, before you go adjust anything, there's something that happened on April 21st that you absolutely need to understand, especially if you already own VUG. Before I show you the next part, drop a comment right now. Are you running a single ETF portfolio, or have you already started splitting into 2 or more? I read every single comment and I'll reply to as many as I can. The VUG split, SCHD, and what I'd actually buy today. Let me tell you about Ray and Denise from Ohio. Ray's been investing for 22 years. Denise handles the household budget. They're a team. In January, after watching the original video, Ray moved about 40% of his IRA into VUG. Then, on April 21st, he logged in and saw something weird. His VUG shares had multiplied by 6. The price had dropped from $477 per share to around $80. He called Denise into the room. "Something's wrong with our account." Nothing was wrong. Vanguard had executed a 6-for-1 forward stock split on VUG. That means every 1 share you owned became 6 shares. The price divided by 6, your total value, exactly the same. It's like cutting a pizza into more slices. You still have the same amount of pizza. Vanguard did this to make VUG more accessible. At $477 a share, a lot of new investors couldn't afford a single share. At $80, way easier to get started. So if you own VUG and you saw your share count jump, relax, nothing changed. Your money is exactly where it was. Now, the question I get more than any other in the comments, why VYM instead of SCHD? Fair question. SCHD is a great fund. It's actually up about 12% year to date, outperforming VYM, and a lot of YouTube creators love it. Here's why I still prefer VYM as the anchor. VYM holds over 600 companies. SCHD holds about 100. VYM spreads your risk across more names and more sectors. SCHD is more concentrated, which means higher highs, but also sharper drops when its top holdings stumble. For a retirement portfolio where you need reliability quarter after quarter, I want the broader base. That's my preference. It doesn't mean SCHD is wrong, it means VYM fits the role I need it to play. And one more thing. I know a lot of you are hearing about covered call ETFs like JEPQ and SPYI. Those funds show yields of 10, 11, even 14%. But here's what they don't tell you on the thumbnail. A big chunk of those distributions is ordinary income, not qualified dividends. That means a higher tax bill, and you're giving up a lot of upside in exchange for that income. SPYI's actual SEC yield is only about 0.5%. The rest is return of capital and option premium. For the smart, prepared investor who thinks long-term, I still believe in the simplicity of two low-cost Vanguard index funds, VUG for growth, VYM for income. Clean, cheap, and no hidden mechanics. Now, let's talk about how to set it up based on where you are in life. If you're 25 to 35, lean into growth. 80% VUG, 20% VYM. You've got time to ride the waves. If you're 35 to 45, balance it out. 70-30 or 60-40 depending on how much stability you want. If you're 45 and up, shift towards income. 50-50 or even 60% VYM and 40% VUG. You want that cash flow starting to build before you need it. And here's a quick tax tip. If you have both a taxable brokerage account and a Roth IRA, put VUG in the taxable. Its yield is so low it barely creates a tax event. Put VYM in the Roth. Those dividends grow and come out tax-free. So, you've got the strategy, you've got the numbers, you know which funds I'd use. But there's one more thing I want to leave you with. The risk I'm watching right now that could change everything.
The risk I'm not ignoring, and neither should you. I'm gonna be honest with you, because that's what this channel is built on. This strategy has risks. Two of them keep me paying attention. The first is behavioral. 2 ETFs means you need to rebalance. Maybe once or twice a year, you check your split and adjust if it drifted. Most people don't do this. They set it up and forget it, which is fine for a single fund, but with 2 funds, your allocation can drift over time. If VUG rockets ahead, suddenly you're 90% growth and 10% dividends. That's not the plan. The fix is simple. Set a calendar reminder twice a year. Check your split, rebalance if it's off by more than 5%. That's it. 10 minutes twice a year. The second risk is VUG's concentration. About 53% of VUG is in tech. Nvidia, Apple, and Microsoft alone make up about 35% of the fund. If the AI trade keeps cooling, VUG will feel it more than VOO. That's exactly why VYM exists in this system. When growth stumbles, dividends catch you. When dividends lag, growth pulls you forward. The 2 legs do different jobs, but only if you actually let both of them work. The investor who understands this doesn't panic in a downturn. They don't chase the latest hot fund. They have a system, and a system beats a guess every single time. Here's the bottom line. 4 months ago, this strategy was a theory backed by 10 years of data. Today, it's been tested by a real market shock, and it held up. VOO is still a great investment. I'm not telling you to sell it, but if you want growth with options, income along the way, and real diversification across investment styles, the VUG plus VYM combo deserves a serious look. If someone you know is still 100% in VOO and doesn't realize how concentrated it's become, share this video with them right now. It could save them a real headache. Tell me in the comments, what's your current ETF split? Are you team VOO only, or are you building something different? I read every comment. And if you're building retirement income and want to stay ahead of changes like this, subscribe to Golden Goals. I cover everything that protects your income. No fluff, no hype, just clear, data-backed content that helps you build real freedom. Next week, I'm breaking down the exact rebalancing rules I use, how often, what triggers it, and the one mistake that costs most people thousands. Make sure you're subscribed so you don't miss it.